Meta just committed $48 billion to rent other companies' computers. Now it wants to sell computing power of its own. This single shift threatens dozens of companies still waiting to go public. Most you've never heard of. But the AI wave is coming. So if you're anywhere near the IPO market, that's your problem too. There's an entire corner of the market built on one assumption. It was simple. The giants, Meta, Microsoft, Amazon, would keep renting computing power. Forever renters, never owners. A whole class of company was built to be their landlord. Now the biggest tenant is talking about becoming a landlord too. 3 things to sit with. 1, why would a company spend $48 billion renting, then turn around and sell? 2, what does this mean for the businesses whose entire model depends on that renting? And 3, what happens to the companies in line to go public right now, pitching investors on a story that may already be cracking? Hey, welcome to New Stock Signals. I'm Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. I read every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. The next wave of public offerings is heavy with AI infrastructure, computing companies, data center companies, companies renting out the machines that train artificial intelligence. Think about how many S1 filings will pitch you the same story. By the end of this video, you'll be able to hear the pitch and know which part of it is already breaking. It's not about predicting the future. It's about reading the structure underneath. Let me define one word first, because it's the center of everything. The word is neocloud. A neocloud is a company built for one job, renting out specialized computers for artificial intelligence. Not email, not storage, just raw computing power for AI. The business model is simple to state, but brutal to execute. Sign multi-year contracts for computing capacity, borrow against those contracts, and race to pay it off before the hardware ages out. Think of it like this. Imagine a housing shortage. Demand explodes overnight. The big landlords can't build fast enough. So a new kind of landlord shows up, fast, specialized, willing to take on enormous debt to buy buildings and rent them at a premium. That's the neocloud. These companies built their businesses on a scarcity condition. AI demand moved faster than the traditional cloud providers could expand, creating a window for specialized rental shops. And the window was real. The names got big, fast. CoreWeave reported a revenue backlog of $99.4 billion as of March 2026. That's contract signed. Money promised. Now zoom out. Every housing boom that runs on borrowed money has the same hidden question. What happens when your biggest tenant decides to build their own building? That's the question Meta just put on the table. Meta was never just a big customer. Meta was the customer. The company expanded its agreement with CoreWeave to $21 billion and signed contracts worth up to $27 billion with Nibius, roughly $48 billion committed to renting other companies' computing power because its own build-out couldn't keep pace with demand. $48 billion. One tenant. Now that tenant wants to become a competitor. On July 1st, 2026, Bloomberg reported Meta is building a cloud business, internally called Meta Compute, to sell its excess computing capacity. 2 paths: let outside developers pay to use AI models running on Meta's own infrastructure, or sell raw computing capacity directly, the exact model the neoclouds use. Think about what that does to the market. If Meta builds enough capacity to supply itself, then sells the rest, it removes a source of demand and adds a source of supply to the same market, both at once. The landlord loses its biggest tenant and gains a new competitor. Same move, same day, the market understood it instantly. Meta shares jumped more than 10%. CoreWeave fell about 11%. Nebius dropped over 12%, all in a single session. One analyst put the structural point plainly. The impact of adding Meta's capacity lands harder on the neoclouds than on the big players, because companies like CoreWeave and Nibius rely on Meta for growth, and Meta may not need them anymore. That's the key insight. The neocloud story was never built on Meta being a customer. It was built on Meta staying a customer, and that assumption just cracked. Here's what changes. The neocloud giants are already public. The Meta news repriced them in hours, but the real exposure is what comes next. Below the big names sit dozens of smaller providers. Some are private today, some are heading toward the public market. For example, example, Lambda raised over $1.5 billion and is eyeing an IPO. Others will follow. Picture this. You're reading Lambda's IPO pitch deck. You see a story built on the old assumption, endless demand, hyperscalers as permanent renters, a shortage that never closes. Now you know you need to read that deck differently. 3 things to look for. First, customer concentration. Ask one question. How much of this company's future revenue depends on a handful of giant tenants? Heavy dependence on a few large customers is the direct risk in this entire group. If one customer walking away breaks the model, that's not a growth story. That's a fragility story. Second, the debt. This is the part the excitement hides. These companies borrow heavily against their contracts, and revenue lags spending roughly 2-to-1 during the build-out. Borrowed money is fine when demand only rises. It's dangerous the moment demand gets a question mark next to it. Meta just drew that question mark. Third, durability. Ask what this company owns that a giant can't simply replicate. The category is separating into different business models with different risk. Some capture more value but carry more exposure. Others sit lower in the stack with cleaner, longer-lasting economics. Not all of these companies are the same bet. Treating them as one basket is a mistake. But here's the mistake to avoid above all. Do not confuse a big backlog with a safe business. A backlog is a promise. Promises depend on the promiser. When your biggest promiser starts building the thing you sell, the backlog is worth exactly as much as that customer's loyalty. Now let me be clear about what this is not. This is not the death of the neocloud. I don't deal in that kind of certainty, and you shouldn't trust anyone who does. Here's the honest other side. Meta's plans are still in development. The strategy could still change. This is a report, not a product launch. No pricing, no timeline, no confirmed date. There's a real legal wrinkle too. Meta does not have the right to resell the capacity it leased from CoreWeave through the year 2032, which limits how fast it could actually bring that computing power to market. So the near-term threat is smaller than the headline suggests, and the demand itself, still enormous. One firm kept its buy rating on CoreWeave after the drop, calling the sell-off a buying opportunity and noting that shortages remain the norm across the industry. Reasonable people are on both sides of this. So I'm not telling you the thesis is dead. I'm telling you the thesis has a crack in it that wasn't there before. A serious investor prices the crack. A hype merchant pretends it isn't there. The pattern here isn't new either. Meta's move comes just weeks after SpaceX, through xAI, struck deals to rent out capacity from its own data centers. The giants are learning they can turn their spending into a second business. That's the real trend. Meta is one data point in it. So let's bring it home. The neocloud story was built on one quiet assumption, that the giants would stay renters. Meta just showed that assumption isn't guaranteed. That doesn't end the opportunity. It sharpens the question you have to ask. Not, is AI infrastructure exciting? The better question is, which of these companies survives if their biggest customer becomes their competitor? Answer that, and you're no longer buying a story. You're reading a structure. This is not about chasing headlines. It's about building a system that still works when the noise fades. If that's the kind of thinking you want more of, hit like and subscribe. We do this every week. Clear ideas, no hype. And if you want the full framework Bill uses to evaluate every major AI break, it's all in his new book. 30 years and 11,000 IPOs distilled into one system. Pre-orders are linked below. A backlog is only as strong as the customer standing behind it. And this week, that customer moved.